Thank you, Hall. So, hey everyone. So this is Mo, part of Think Capital Network Group here. So, for those who attending for the first time, so we connect startups and investors for funding through a series of events we're doing on a monthly basis, between 6 to 8 events. And this event today is the format is going to be 5 minute pitching, 5 minute Q&A, and then we can start with Randy. Randy, are you ready?
I am, yes.
Yeah, just go ahead. Please share your screen. You're good to go.
Okay, thank you. Hello, everyone. I'm Randy Hubbell. I am the CEO for Solaris Endovascular. We're a medical device company with a platform technology to solve problems associated with the endovascular space. I'm just going to focus on two products that we have that are in the advanced stage. One is commercial. The second is got breakthrough designation in phase 2 with the FDA. Here's the summary of the investment opportunity. It's a recurring revenue from our Solaris SX product. It's a self-expanding nitinol covered stent being sold overseas, $5 million of annual recurring revenue. Our second product's a combination product. It builds off of that platform by putting a drug on the metal edges of the stent. I'm going to show you a picture of that. And we've completed phase 2 enrollment. The data looks super fantastic. It's truly transformational, and we have gotten breakthrough designation. Got strong interest from strategics. Management team's done this before. We've been very capital efficient, and we've tried to reward the early investors in this bridge round. So we're on a bridge round that we're closing on June 30th next week, on a path to a equity round. We take care of patients that have challenges with the arteries and veins in their arms and legs, anywhere but the heart and the brain. For PAD, peripheral artery disease, it's the same atherosclerotic disease as what would be in the heart. And so when it shows up in the legs, particularly the lower legs, becomes very problematic. Dialysis access patients, there's a circuit created by putting a vein and artery together. That circuit gets damaged. That damage causes a lesion, a stricture, or stenosis. It's all the same thing. It's a blockage of blood flow, which is life-threatening for those dialysis patients. So we have two products. One is our first program is Solaris SX, approved in 45 countries outside the U.S., including MDR CE mark. It does about $5 million of revenue through independent distributors. It's very competitive with 3 other companies. One is Gore, Bard, and Merit. They all have products in this space. The second program is the game changer. That's the shiny object here. It is a combination product. It takes this stent that you see on the left that is a nitinol self-expanding stent covered with PTFE. The metal edges are intentionally left uncovered with PTFE. We put drug on there, and that drug elutes over 60 days, and it cures restenosis. It prevents it from clogging off. The technology that we have on the base platform without the drug, like I mentioned, is very competitive. We're #1 market share in Turkey and in Brazil because we have great features such as radial force combined with flexibility, a unique combination. We have data on this program. I'm not going to go over this data because I'm going to show you the data from the drug-eluting, which is extremely impressive. So all covered stents, ours and everybody else's, has a problem, what's called edge restenosis. What you're looking at here is the metal mesh is the stent. The black in the middle of the stent is contrast. It's showing blood flow. It is open. It's working properly. Our PTFE and the PTFE of our competitors does a very good job of preventing in-stent restenosis, preventing a cell migration and clogging that stent. But the cells migrate on the edges. That migration of the cells causes neointimal hyperplasia, or think of it as scar tissue, and that clogs the arteries. So that is a big challenge and something that we have solved with our drug-eluting program. So we put the sirolimus on the edges. Sirolimus is a very well-known anti-proliferative, anti-inflammatory drug, very safe profile been around for 23 years. I launched it at J&J in the coronary stent world. We hit $1 billion of sales in 8 months. It's a fabulous drug. We're looking to repeat that here in the peripheral outside the heart. This is going to cure that 1 in 4 problem of edge restenosis, and we have the data to prove it. So the data you're seeing here is a 6-month endpoint. It's a primary endpoint for dialysis access. So when a dialysis access patient presents with decreased flow because of a lesion, it's not working, that lesion needs to be repaired. With balloon angioplasty PTA, at 6 months, about half of those are coming back because that repair was not durable. When you look at covered stents without a drug, ours and the one from Gore, Bard, and Merit, they all have about the same results, which is about 75% patency, or about 1 in 4 fail. Our technology with the drug-eluting is 95% patent. So we have the ability to keep the vessel open, and the picture on the right is showing that we have no scar tissue. So we're set up for an exit. These are the companies we are engaged with. These companies do not have a covered stent. And we have a $5 million convertible note that is used to hit some significant milestones that we've already hit this year. We've hired the FTEs. We have breakthrough designation. Part 1 of our IDE submission is in. There's a very simple play. 1 pivotal study, 1 PMA, and we'll get acquired before commercialization. We got $5 million now, $25 million in a Series A. It's a 10 to 12x return for early investors. So it's a convertible note. It closes June 30th. 3.75 of the 5 is done. Another $1 million's committed. We got 2 to 3 soft circled. We're working through those details with a VC now. 8% interest, 25% discount, and $50 million valuation cap. Thank you.
Thank you, Randy. Appreciate it. So we now we have all the investors joined us. So let's just start with a quick introductions from the investors. Everyone just to kind of give us the name and the fund, and then we'll start with 5-minute questions for Randy. I think I have here the list of the investors, so we can start with David Mandel. David.
Hello, this is David Mandel. I'm managing partner at Emerging Ventures Capital. I'm based in Los Angeles. We invest in seed stage B2B tech startups based in the US and Canada.
Thank you, David. John Bagley. Not here. Okay. I think we have Stuart Sakalaka.
Can you hear me?
Yes, we hear you.
Hi, I'm Stuart Skalka. I'm based in Reno. I'm with the MIT Alumni Angels of Northern California, based in the Bay Area.
Wonderful. Anissa?
I'm here from ShellRock Ventures. We are investing in fintech, B2B SaaS, and future of work.
Thank you for that. GC, Shan? GC? She's
Hi,
not here yet.
this is Jessie. Can you hear me?
Okay. Yeah, we hear you. Yes.
Sorry, I'm late to the event.
You get.
We have a network of investors across different stages. We do top-down market research and investor collaboration to help with venture building. We focus on deep tech, like semiconductor, space tech, advanced manufacturing. Nice to meet you all.
Wonderful. Thank you. Then we have Tam. Tam, are you here? You can unmute yourself. No, Tam's not here yet. All right. So, and then last we have Alan Mason.
Hey,
Alan.
Good afternoon. Yeah, hi, good afternoon. This is Alan Mason at MBA Asset Strategies. Do you hear me?
Yeah, we hear you.
Okay, great. I'm an asset management platform. Our company was put together with some ex-Solomon Brothers partners and alumni. We have really 2 opportunities for clients to invest. One, which most people can't get involved in with high frequency trading and and market making credit area.
Okay.
So and that's what we do.
Wonderful. And then we have Dante Colley. Dante. Hello. Can you hear us?
I only hear the sponsor.
No. Yeah, can you unmute yourself? Just say a little bit about what we do in terms of investments. All right. We can't hear you. Anyway, so let's just start with questions for Randy. Yeah. David, do you have questions for Randy? David? No? All right. Okay. How about Dante? Dante, do you have questions?
Sorry, I was couldn't unmute myself for a second, but no, we don't do anything in healthcare in general and medical devices in particular. So this is beyond me.
Thank you for that. Dante, do you have questions for Randy? No? All right. So, Stewart, do you have questions for Randy? Stewart? You muted, by the way. You know. All right, can't hear. All right, so let's just move on to Anissa. Do you have questions for Randy?
No question specifically, but are we going to receive the pitch decks for the meeting?
All right, so you wanna have a look at the pitch deck?
Yes, please.
Yeah, for sure. I'll make sure that you have that right after the event. Thank you for that. JC, do you have questions for Randy?
No, thank you.
All right. Okay, cool. Thank you. How about Tim? Tim, do you have questions for Randy? Tim? All right. Let's just move on. Alan, do you have questions for Randy?
Yeah, hi. Just a quick note. I didn't hear the entire elevator pitch, unfortunately, as I'm on the road. However, I'd like to take a look at the pitch deck. If you guys can tell me where you are in your capital raise and whether or not you utilize services that will help you raise capital that you're looking for, with retainer, without retainer, and with success. Can you answer that?
Yeah, Alan, we've been working with Hall for a number of months now. We're at the end of the round.
Okay.
We have a final close next week.
Great.
We've got some VCs coming in, so
good.
small VCs. We're going to be transitioning to an equity round there where the debt's going to convert, and we're going to hire TD Cowen out of Dallas Fort Worth to be our investment banker to do that, because it's going to be heavily focused on the strategics that you see on the screen here. And we expect that one of the strategics will lead this round.
Well, that would be great if you got Johnny John or somebody like that in. That would be wonderful on your cap table. So congrats on that. Okay, well, it's a little late for me then, but I appreciate the color.
Thank you.
All right, with that, let's just move on to the next presenter. And then we have on the list, I think the next will be ChillShark. Are you ready?
Yes. All right, let me pull this up.
Cool. Yeah, please share your screen and you're good to go.
All right. Can you guys see it?
Yes, we can.
Okay, cool. Sorry.
You're good to go.
Yep, pulling it back up. Alrighty. Well, my name's Keegan O'Connor. I'm the co-founder and CEO of ChillShark. And today I'm going to tell you a little bit about our product, our business model, and how we plan to exit. So what you'll see over the course of the presentation, we have a 2-year contract signed by Four Seasons Marriott, about the 4 pilot locations selected, few NBA customers, and a clear strategy to execute on manufacturing distribution. But first and foremost, the problem itself, it's very clearly articulated in this video.
This is like ridiculous. Look at how nice. They brought me a little shovel. Like traveling with me.
So basically what we learned was this is how they service, the 6 to 8 request. Four Seasons Philly, this is how they service 6 to 8 requests. Sorry?
No, you
Okay, I'll just keep going. So our solution, it solves the problem for them in a way that makes sense. So it turns any bathtub into a cold plunge. When you look at the luxury hospitality market in general, wellness is a core focus, given the the change of spend across their guests. What we're seeing is they oftentimes are going to have to make expensive investments in order to actually try to offer something that will be helpful for their customers. Because the consumer tubs, they fail the brand standards. They aren't going to make sense to put an inflatable cheap tub. The legacy spa installs costs a significant amount of money in CapEx, plus they have to have plumbing and space for it. But the demand is already there. So, every professional sports team that stays, on top of that, they get 6 to 8 guests requesting this, ice brought up to their room for ice baths. So the demand is there. The solution of turning a headache into something that generates cash flow is ChillShark. So we have the brand standard, we have the consistent, temperature filtration, the protocols, and then on top of that, we actually are giving something that fits into their processes that's really easy for them to understand. So all they have to do is fill the tub up, set up the ChillShark, they can pre-schedule it, and then it'll be ready for them. And at the end of the day, when you look at the reason why hotels are buying this, they're going to make revenue. They don't have to spend CapEx, but from an operational standpoint, servicing cold plunges specifically is very difficult because you're entirely reliant on the vendor of choice. So you can call a random guy to come fix a pool or a hot tub, but somebody fixing a specific cold plunge typically requires the service of the company. So scaling is difficult from a service perspective. We're able to ship them a unit next day or remotely diagnose, where the problem is. So the operational complexity is reduced significantly. So we started with launching a Kickstarter. We did, close to $500,000, outpacing, some other larger brands, but we really got pulled into athletics, which is ultimately what made us land on luxury hospitality. So we have NBA teams, NHL teams who've paid us. We have a 2-year contract signed with Four Seasons. But the reason why we're solely focused on executing within luxury hospitality is ultimately to use luxury hospitality to unlock the athletics and the premium consumer. So it gives us a demo showroom in every major market. And I'll probably pass over to Venkat real quickly.
Thanks, Keegan. So let's start with the business model. So of course, the majority of our revenue is going to be hardware, the unit sale or leasing or other types of services. And then we have the repeatable recurring revenue, which comes from the consumables. So we have a custom filter, the sanitization kits and the service kits, and then the fleet management platforms, basically for operational support. And then the hospitality rev share, that's really where the gold is, because They want to really generate operational revenue and then giving us a revenue share for the platform which we are creating for them. And the revenue is basically 85% hardware, and the rest of it is the software. And it's just a basic unit economics. We're using a blended hardware ASP of $5,000. The production COGS at low volume right now is $2,100, and we have a 10% reduction with some value engineering going down to $1,700. The gross margins are at around 42-43%. And we've capped the recurring hardware at around 15% to 25% growing. And we just have all this has been validated with the supplier quotes, the contract manufacturer estimates, etc. So, right, next one. And this is our growth bridge. So this is our upside of $139 million in year 5. These are the unit economics, which you can see. What we have not priced in right now is the AI platform, which we are developing with our medical advisory and research advisory board, the recovery intelligence, which will give an additional dimension to this, the technology dimension to this business, which we are developing.
And since we're basically at time, I would imagine. So, right now we're raising 1.5 million to scale up manufacturing. So we'd be happy to take any additional questions, but want to make sure that we're keeping pace to that 5 minutes.
You're raising 25 million at what valuation?
We're raising 1.5 million at a $10 million valuation.
You're raising 1.5 at 10. Okay.
Correct.
And where are you in the round right now? How much have you raised so far?
So we've raised about 300, and then we have about one. I'd say we're closer to 1 million soft circle.
Okay, and I would assume it's all friends and family, no institutions on the cap table yet.
So to date we've raised 1.8 million. So we have a couple of VCs, we have 8 professional athletes, and then before that we did like a 500K.
So you have a lead?
For this round, we have Anthony Rendon, who he's put in like 750K. So his like family office set terms.
Okay. What's your current burn right now?
We got to scale up manufacturing. So our current burn's only like 20 to 25K a month, but that'll quickly increase as we start to allocate capital to scale up the tooling.
Right. And what's the use of proceeds on this 1.5 you're raising?
Venkat, you want to talk about the manufacturing?
Yeah, it's basically scaling up the manufacturing, getting the certification. So we have a path for that, the batch certifications, the line certifications, the inventory, scaling up the inventory to basically deliver to some of our customer commitments, setting up the hypercare, the customer service, all the deployments. So it's a standard manufacturing setup, basically.
Okay. What's your expected revenue next year in 27 and 28?
So
next year is.
Next year, let's talk about the hypercare model. You talk about hypercare now, Venkat, if you can.
Yeah. So this year we are doing pilot units. So we have a 200,000 revenue at the end by this year. So we're setting up the hypercare model, and then next year we go up to around 12 million, and then it goes up to 60 million after that.
Which is around it's around 2,000 units.
Yeah.
How many customers do you have right now?
So we've pre-sold 140 units, but the Ritz-Carlton and the Four Seasons both are corporate sponsored, and we're building out the SOPs that we can then roll out across their portfolio. For Marriott specifically, they see about 650 to 700 properties where we could add value in their like luxury portfolio. So on top of that, we're getting slotted into some residences projects. So like an 18-unit project in Nashville, for example. So we have like the demand isn't really the constraint. It's okay. How do we scale up manufacturing in a way that is
operationally stable? That's basically my background. So making sure that we have a sustainable business, operationally stable, taking care of the quality, the customer service, the hypercare, so that we can match the brand promise.
Yeah. So the time you build a unit, the time you deliver the unit, what's the conversion ratio? How long does it take for Marriott or Ritz-Carlton, whoever it might be, to acquire these units?
Like right now, currently,
Yep.
or in the future. So we're just delivering the pilot units right now.
Okay,
So we're
you're
not,
doing pilots.
yeah,
Okay.
yes, sir.
Okay, thank you for that. Okay, thank you very much.
Thank you, Alan. Any other investors who have questions?
No, that was a lot. I threw out a lot of questions just now.
Yeah, I know. You did great. Any other investors?
Do we have any other questions now? No, I mean, you guys want to send me a deck, fine. I mean, I have a twofold business. One, of course, I'm in the asset management business. The other is that I'm a capital markets guy for the last 30 years. So, plenty of people that I know that could be looking at, pre-seed, seed, A rounds, etc. But unfortunately, for a lot of young companies, I charge a retainer and a success. So if the companies can't afford that, then it's a mute conversation. I understand that, but it sounds like an interesting story.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you. Yep. Any other questions? Anybody? Anyone from the investors? John, I think John just joined us. John, do you have questions? All right.
No,
so
sorry,
let's
it took me a minute to get to the the unmute button. No,
All
I just
right.
joined, so I don't know what the presentation was, so I don't have any questions.
Okay, that's completely fine. Let's just move on to the next presenter. And then we have Aether. So, Aaron, are you here? Yep, you're good
I
to
am.
go.
Yeah, let me
All
just get this
Good.
going here. Hold on. Okay, can you hear me?
Yes, we can.
All right. Well, I'm sitting here in a corner of the upstairs convention center at Bio, so hopefully the audio visual works well. So thanks for this. So we're a clinical stage biotech company working in the pain and addiction area. We're a neuropsych specialty company that have developed or are developing, a novel molecule to treat pain and addiction. So that novel molecule is our solution to the opioid crisis. It is basically a neuromodulator that suppresses the dependent signals that are emitted in the brain from giving somebody an opioid while preserving the analgesic signals. So we're combining this compound with an opioid to treat pain without the risk of addiction. We can also treat opioid use disorder as well as neonatal opioid withdrawal syndrome. So the investment thesis is quite compelling. I mean, obviously, we all have been affected by people who have suffered from the opioid crisis, and one of these pictures actually is a family member of one of our co-founders. But in addition to the great societal impact we can make, the investment thesis is relatively attractive. We've already completed safety in humans. We've got 2 tox studies that are clean. We've got a full battery of non-clinical evidence in models that historically have been predictive of the human condition. So we're going to take that data, go do a couple of studies, and expect, if they read out positively, to have a pretty significant value inflection point relatively quickly and cheaply. Our team is quite seasoned. Wolfgang Sadi is the inventor out of UCSF. He's a preeminent researcher in the field of pain and addiction biology. He's got over 400 publications. Myself, I've held leadership roles in operationally and financially and corporate development across biopharma for over 30 years. I was part of the early team at Coherus that went from startup to a $700 million market cap within 5 years. Rick Hawkins, a serial entrepreneur with many successful exits. And our drug development team is quite seasoned as well. So we're going to focus this on pain for now in a short presentation. So the pain opportunity is basically to combine our drug, as I mentioned. It's the ultimate commercial formulation will be a co-formulation of our drug with an opioid as a single tablet taken daily, orally, basically to treat pain without the risk of dependence. That's the basic formula. We've already demonstrated safety, and the safety window is quite large. We did those studies with the prior formulation in the US. These studies we're going to do in Australia, where we can do them more quickly and cheaply, but without sacrificing any quality. So we're raising a $10 million bridge, $13.3 million pre-money. We're going to use those funds to go make a batch of material for the clinic, go down to Australia, do 2 studies, And we're going to enroll patients that basically are on chronic opioid therapy who have a baseline level of dependence and a baseline level of pain management. We give them a dose of our drug on top of their opioids, and within about 3 to 4 weeks, we should see a decrease in the dependence scores from baseline with no change in analgesia. If we can demonstrate that, we've got a clinical data set that benchmarks conservatively at about a 10x valuation from the current pre-money. And where we're getting that valuation is there's been a couple of deals recently done in the non-addictive pain space. The floor on those deals have been $300 million. We expect we'll have a greater level of human validation from these studies than either of those deals had at the time of signing. And then also we have an opportunity to go after a pediatric orphan indication as well with eligibility for a pediatric review voucher, which is valued at about $200 million. So when you look at what's going on in the pain market, everyone's working on trying to get away from opioids. And so these are some of the drug targets that they're working on here on this slide. If you think about pain drugs as analgesia benefit versus safety, opioids have the best analgesia properties, but obviously have the lousiest safety profile. And that's why everybody wants to get away from them. But all these other targets are all sacrificing some level of efficacy for better safety. So in other words, none of these are achieving opioid equivalent analgesia. So as a result, if 100% of these drugs actually got approved, opioids still aren't going away. So our goal is basically to make them safe. So our TPP is basically opioid equivalent analgesia without the risk of dependence. We're the only TPP in development that can make that claim. So we've got about $7 million into the company so far, mostly through grants and early founder money and seed money. We're now at a point where we're raising our first institutional round. It's a $10 million convertible note. We have a lead investor, $4.5 million committed from a large institutional fund. And we got about another $1.5 million circled of pretty hard commitments towards that $10 million target. With these funds, it's pretty straightforward. Go run 2 studies. If they read out positively and all indications are the medication's working, then conservatively, you're looking at a 10x return within 2.5 years, roughly. And we've got a relatively de-risked data package and a de-risked plan and a team that has been there and done that in terms of drug development. Thank you.
Thank you, Aaron, for that. Appreciate it. Any questions from the investors? Should we just go through the list? Maybe we start with David. David, do you have questions? If not, then we can just move to John. John, do you have a question?
No, you don't have to call on me. I'll let you know if I have questions.
All right, wonderful. All right, cool. Stuart, any question? No? All right. Anissa? You good? Okay, Jesse? Any question?
Hi, I'm not an expert or I'm not familiar with this space, but this is old problem. What is the market landscape look like? The other solutions, competitions, etc.
Yeah. So the pain market currently is about $40 billion of moderate to severe pain, both chronic and acute. And so if you're treating moderate to severe pain, unfortunately, opioids are still the only game in town. There's about $36 billion of opioids being prescribed every year around the globe, about 20 billion in the US. So our goal is basically to make this a second generation opioids. In terms of competitive landscape, this right here on this chart where it says NaV1.8, that's called a sodium channel inhibitor. Vertex just launched one. It's called Journavax. It's the first non-opioid pain therapy to come to market. The launch has not gone well. And the reason the launch has not gone well primarily is because of where this circle is on this graph. Basically, they just did not achieve opioid equivalent analgesia in their clinical studies. And so a number of companies going after this target, as well as the targets that are listed on this slide. And as I mentioned, if 100% of these were to work, opioids still aren't going away. So our target product profile is basically to create an opioid, or basically add our compound to an opioid in a single pill that would basically be best in class, first in class, going after the $40 billion market. Beyond that, there is latent demand of about another 100% on top of that. And there's also price premium opportunity. So we believe the total addressable market is actually closer to $50 billion in pain. We can also go after opioid use disorder, which is as addressable market about $5 billion. And then neonatal opioid withdrawal syndrome, which is about another $1.5 billion market, plus a pediatric review voucher. So all in, the total addressable market approaches $60 billion when you add it all up.
In medical space, the adoption barrier is significant.
Yes.
So how do you break that?
Yes. So this will be a scheduled drug, to your point, because opioids are a scheduled drug, and an opioid agonist will be a part of our ultimate commercial compound, combined with our modulator. So in spite of the fact that it's a scheduled drug, as I mentioned, there's $20 billion worth of that stuff being prescribed legitimately every day in this country, or every year, I'm sorry, in this country. So anyone with a GP sales force or anyone that is currently working in the pain space has the commercial infrastructure to penetrate this market and convert it. And so we'll be looking to partner and exit to those companies once we have this clinical readout with this fundraising. So there's plenty of companies who have the ability to do that. If we were to go alone and not get the exit, what we would actually do is we would go straight into a registrational study into the neonate indication. And there we could commercialize that ourselves. That's about $1.5 billion addressable market. That's not likely, because more than likely, if the data is successful, then we'll get taken out by then. But if we did stay independent, that would be the first market to go after. And there, it's a relatively small sales force. The one thing I want to point out, and one reason Jornavax has not been successful, besides its efficacy, is the fact that doctors, surgeons, dentists, they're all right now accustomed to prescribing opioids for moderate to severe post-surgical pain as well as chronic pain. And so actually to get them to adopt something other than what they've been doing for the last 20 years is really hard. Where we would come in is basically tell the doctors, look, you get to keep prescribing what you know, but this is the safe version of it, and here's the data. So I think market conversion with that story is going to be easier than someone trying to come in with an entirely new mechanism of action, an entirely new data set.
Why do you think it's easier for your medicine to be adopted?
Well, I think primarily it's because it fits the current standard of care. Doctors take a long time to convert to a new therapy when they're accustomed to a current standard of care. So that provides us a benefit over anyone else, because we can basically go to the doctor and say, you can keep using the standard of care that you've been accustomed to for the last 20 years, but it'll now be safer. You don't have to change targets. You don't have to change mechanisms. You don't have to get educated on a whole new set of biology. So we take advantage of that. So it seems, also, if you look at the warfarin market, this was one where it converted within 5 years, billions of dollars converted when the new safer anticoagulants came out. And same thing here. When there's an unsafe drug that's a standard of care and something new, safe comes along, the market historically has always converted very quickly.
All right, wonderful. So I think that's kind of the end of it.
Okay, sorry, you didn't ask a question, but Keiretsu Forum Northwest is sending a draft diligence report this week, actually. So that's 2 diligence reports we now have available.
Due diligence report you can share.
Yep, thank you.
Yeah,
Wonderful.
that's great. Thank you.
Thank you. With that, let's just move on to the next presenter. We have SkyMirr. Are you ready?
Sure. I'm going to do a change of pace here, certainly.
Okay.
And we will get this to you guys. I'm assuming you can see it well enough. Pre-apologies if I'm hacking and wheezing, guys. I'm one of 2 founders in SkyMirr. My partner, Eric Joe, and I are, in my case, the chairman, in his case, the CEO of the company. He is in South Korea right now, and I just landed from California. That's how this goes. SkyMirr is a product company with extremely high connectivity performance for 5G connectivity and Internet of Things. We have manufacturing in South Korea and Taiwan and Vietnam. We have engineering in South Korea and at our headquarters in Florida, and we have sales around the world. I should tell you when we start, before we get into specifics, that this discussion is around an extension to our Series A. The Series A was for $7.3 million. Our lead investor is Solaris Capital north of Detroit. They will participate in the extension, and the particulars I'll share with you in a moment. The particular issue today, and I'm going to skip and choose, has to do with this busy chart, apologies for that in performance in wireless networks, the big issue is the antenna. Even though it's a cheap little thing, and you can see the red in the pecking order of this, we are world-class guys in antenna products and the products themselves that the antennas are embedded in. So between he and I, we have that front covered, and we have produced multiple products in the 17 months since we've been funded, just 17. And the reason, by the way, for the Series A extension, to the extent that you might ask, is because we are going to increase our revenue stream before we go for the big Series B growth enchilada. Why SkyMirr? The first company that, in fact, in IoT and broadband that focuses on performance, amazingly enough. And so we have patented, not patent pending, 15 patents in the SkyMirr area. And it applies to every antenna we make, every 5G router we make, which is the thing in your closet, in your home, or better yet, in your business, that actually allows you to communicate Wi-Fi throughout your building, your particular, your particular home, your building, your warehouse, etc. And the reason that that's important is because today there are a wide variety of situations in which this performance fails. Think of all the places in Africa. Think of all the places in South America. Think of all the places in the United States where it's just too hard to get connectivity, especially 5G connectivity, and we do that. And we have a variety of other products that we do it for. In this particular 17 months or so that we've been operating, these products have been awarded a variety of industry awards for their technology and the product. Our router product, that is to say, that thing that doesn't connect to your fiber cable plant, but out the back to 5G, was awarded an innovation award at the Consumer Electronics Show in Las Vegas. And you can read the rest of them here should you be interested, and this matches your investment profile. We're very proud of that, and obviously it's a great marketing tool for us. The product line that we have brought to market in this interval of time has three elements to it. The antennas themselves as standalone devices, so you can put video security devices throughout your business and the periphery of your business. Our Sky 5G router that produces extremely high-speed Wi-Fi inside the building to a multiplicity of users, as many as 500. And our Sky tracker that actually allows this device to sit in trucks, in military gear, to the extent that you care about that, and all other places where you need to know not only where it is, but the humidity, the temperature, its height, not just its XY coordinate, et cetera. So in this interval of time, in this Series A round, which is, of course, only partially spent, we spent about 6 of the 7.3 to 5, 7.3. We've produced 10 products, all of which are in mass production. And what this gets at is the fact that we're not rookies at this. I've had 3 exits. Eric has had 1. We are veteran performers in this space. And one of the things that we realized in doing so is that to get to market, especially to the customer space that we focus on, that we need powerful channel partners. So I'm happy to be able to report, and I'll scan down to that in this chart, that we have just such powerful partners. Let me go here. So carriers and channels, these are the guys that help us get to market around the world. We have existing marketing and certification and sales partnerships with T-Mobile, the best guys in the 5G world, frankly, as well as Verizon, who's making a big comeback, with AT&T to follow. CellHub is one of their major distributors and resellers, and it's the major agent for T-Mo. They are our partners as well. These are closed deals. If you want, you can actually go online and you can find us at Amazon and Walmart as an individual investor, individual customer, I should say. Go take a look, and you'll see not only some of our antennas, but our router as well. Think of routers that cost about $550 a shot, depending upon whether it's a direct or indirect sale. Think of antennas that are between a few dollars and actually a couple of $100 for very, very powerful extenders into large warehouse space. And they would be, again, a couple of $100. So with all this in mind, we are just now at the point of launch. We have existing inventory for our 5G routers. We're putting the antennas there as well. They're fully certified now and ready to go. And because of that, you're going to see the revenue growth that you see here in the next few years, not for the 5-minute version, but it's built bottom up. And if you were to take a closer look, you would see that it's broken down by product line with margins in the 40s. The team I mentioned.
Ask.
Say again, please.
Yeah, can we move to the ask?
I'd be happy to. Let me remind you, as we glossed by the team, that Eric Joe is the world-class expert in antenna design, including MIMO antennas and other complex ones, and it matches our technology. And let me remind you, with respect to the ask, that we have raised 7.3 with dry powder left. It's an extension. Therefore, the terms are set. The due diligence is done. We welcome to call our lead investor. We're going to raise a maximum of $5 million for the Series A extension. Of that $5 million, $2 million has been spoken for. And that's it.
Thank you. Appreciate it. Now let's just move to the questions section. Who wants to kick this off? Any questions?
What's your current revenue?
It's about $100,000 for this year. The second half of the year, it'll exceed $1 million at the minimum. We have a funnel, an existing funnel of about $750,000 here in June, with more to come.
So is retail your main channel to sell your product?
Would you repeat that, please?
Is the retail channel your main?
No, as I mentioned before, the objective here and the reason is simple. It's scale and access to a variety of customers is small to medium businesses and over time enterprise. The reason we use T-Mo, Verizon, and soon AT&T is because their sales channels and their channel partners that I mentioned have access to these larger companies.
Okay, so my question is, it seems that your revenue ramp up is a little bit slow. What's the challenge here?
The challenge was simply bringing the products to market making sure they were heavily quality controlled and supportable. And so I honestly, with all due respect, wouldn't call it slow. We got our Series A funding in December of 2024. So before that, there was, a small amount of trials and NRE jobs that we did to raise a little interim money. We're actually pretty proud of how fast we've come to market.
The major users are companies that can use your technology to build products, right?
No, to use them in their business. Let me give you a couple of examples. These are our antennas can be part of somebody's product, but the large ASP products, such as the router for $500, not 20 or 30 bucks, as well as our tracker for shipping across the country, are devices that cost between $500 to $600 for the router and about $150 for the tracker. So if you think of the router, think of a point of sale company that wants to ensure that all their locations, including those hard to reach areas, can do transactions and record the information back. Think of Harry Winston, the jeweler, who has many, and this is a real example, as you might expect. Think of Harry Winston that has stores throughout the country, including ever increasing. Think of warehouses that want to be able to track where things are, and trucking firms that ship to those warehouses that want to be able to track not only where the product is, but the possibility, and I haven't covered this today, that it's been stolen. And if it's been stolen, when was it stolen and where was it stolen and what direction did they head? So these products are used actually by companies to make their business succeed.
Okay, so what are they currently using? Because I think they are tracking their stuff right now.
Yeah, they sure are. They think of devices that cannot reach as effectively through the metal in the truck. Remember, this is an RF connectivity differentiator in our products that will actually be able to communicate what's going on in real time at large distances from towers and through any kind of metal device because the link is stronger. And by the way, a whole suite of sensors that will tell you everything that's going on inside the truck. For the router, think again of businesses that are having trouble. Either they have fiber that breaks all the time and they need backup, or they have remote stores or outlets that can't communicate reliably and they have to keep customers waiting.
Okay. So the antenna is a key technology here.
You bet it is. And one of the interesting things is that it's, again, heavily patent protected, not patent pending. And it is a piece of the architecture that does not put us at a cost disadvantage. Mm-hmm. It's physically not significant to produce. The question is, upon what design is it based?
So who are the Taiwan? You say you manufacture in Taiwan? Sorry.
Partly in South Korea, partly in Vietnam. Antennas in Vietnam. I'll be happy to discuss more about who they are offline.
Well, thank you for that. So I'll definitely make an introduction and share decks and make an introduction by email share. Yeah, sure. For sure. Yeah, thank you for that. So with that, let's just move on to the next presenter, Noleus Technologies.